Hello, my fellow investors, and welcome back to another viewer-requested fundamental analysis video. Today, guys, we're going to cover another one of your recommendations. However, it actually ended up that I kind of already covered this. So for all of those of you who do not know, I have been live streaming this week only to Rumble, and well, today we did a stock recommendation, and it ended up coming out to be, I'm actually going to post the video where I spun the wheel because I was recording it, and it actually ended up being the company RILY. So guys, this one was brought up by KLL. Here is the post right here, and you know, we kind of already did it on the live stream, but when it came out to be this one, I'm like, you know what, I feel bad. That this isn't going to go on YouTube. So I was just like, or at least I'm not going to give it the full due diligence as it should, right? I mean, it's KLL. I care about all of you guys, obviously, that watch, but KLL is like one of the main ones on this channel. So I really want to do my due diligence when it comes to this company, since I know she's been here for a while, right? For a while. So I figured, you know what, I'm not just going to do that to her, so I am going to do a full video. I mean, this was going to be it anyways, it's just I want to do the full analysis on it and not just like half-assed kind of in a way through the live stream. So we're going to cover the company RILY. I kind of already know what it is. Everything's already inputted because I already covered it. So with that said, let's get started with this analysis. So here is the company's website. They are a financial company, and if we take a look at their company profile, we can see that B. Riley Financials Inc. through its subsidiaries provides financial services to corporate, institutional, and high net worth clients in North America, Australia, and Europe. The company operates through 6 segments: capital markets, wealth management, financial consulting, auction and liquidation, communication, and consumer. The capital markets segment offers investment banking, equity research, institutional sales and trading, securities lending, fund and asset management, direct lending, venture capital, proprietary trading, and investment services. And they just keep going on, right? They just keep going on as to what all the other segments mean. But they are in the financial sector. And I'm going to take a look at the graph. It's actually insane. Now, with that said, if we take a look at their earnings, we can see that they had their earnings on May 8th, and EPS normalized actual came at 17 cents. We don't know if it's a beat or not. And this company, again, is in the United States. It's in California. Yet, guys, we don't really have much data here, which is kind of weird. But EPS gap actual, we don't have anything. Revenue actual, $95.78 million, which was a beat by... right? We don't know. So at least Seeking Alpha doesn't say, and there really isn't much of anything here. So yeah, I think this is a company that when it comes to Seeking Alpha, they just don't prioritize it. That might be it. That might be the case. I mean, they are a company here in the United States. If this was a foreign company, I'd be like, all right, kind of understandable there, but it's not. So very, very interesting to say the least. Now let's come into the discounted free cash flow. We got the company for RILY, market cap of $1.2 billion with a PE of an A. Well, the thing is that, well, I think this mainly has to do with the fact that, again, if we take a look at their earnings, the EPS gap actual is non-existent. So I don't necessarily know why this is an A. All other ones work. This one doesn't, so just keep that in mind. Current share price of $44.12. The market is currently open. It is almost 2 o'clock as if I'm recording this. And if we take a look at what this thing has done in the past year, we can see that it is only up 0.36. Year to date, they're up almost 30%, which is crazy. And as of right now, well, the markets are tumbling, guys. The markets are tumbling. I did cover this on the live stream. Basically, ADP numbers came in smashing, like completely smashing, and that's what caused the market to fall. So we'll cover that later, probably tomorrow. Honestly, we'll probably do that tomorrow when Mike and I talk about the update when it comes to everything. But nonetheless, though, the market right now is currently down a significant amount, which is causing this company to fall. Also, remember, financial sector, not surprising that this company is falling because the financial sector has been hit massively, right? Massively. So that's just that. Coming back into the discounted free cash flow calculator, we can see that they do pay out a dividend of $4, which is mind-boggling. In fact, this yield is just insane. 8.83%, guys. Absolute crazy. Look at that 5-year growth rate. 62%. That's insane, with 4 consecutive years of dividend payment. If we take a look at the history, we can actually see that, yeah, this thing is all over the place. All over the place. Another company, at least in my personal opinion, another company to buy for its dividend, mainly because of the fact that it's just not really that reliable. See, just over here, this is a whole mess. Then they kept it, they've always kept it around $1 or so, but as of right now, it's $4. I'm not fully certain, guys. Actually, I just realized, never mind. This is on I always forget, this is on a per share basis, not an annual basis. So that actually makes sense, because if we come back over here, we can see that amount is $1, right? So dollar times 4, that is $4. So yeah, it is what it is. I still don't necessarily like it, especially with the fact that we don't have a payout ratio. The payout ratios in regards to the free cash flow is even, oh, it's horrible. It really is bad. So we're going to see that in just 1 second. Ex-dividend date passed as of May 15th. Payout date was on May 23rd. And of course, they pay their dividends quarterly. Looking back into this, all right, here's where the dividend just falls apart for me. We got amounts paid in dividends every single year in millions, $112 million, based off, of course, the shares outstanding. After this is paid, in regards to the 5-year average free cash flow, they're left with negative $120 million. That's a lot, right? That's a lot, and the negative. That's huge. Now, as of their last year's free cash flow, it is negative 120. They cannot afford this dividend, guys. They cannot afford this dividend in the slightest, and these payout ratios are just ridiculous. So yeah, I'm not. Yeah, when just looking at this right here, yeah, they just can't afford it. Just can't afford it at all. So it is what it is. Massive yield, but not from a financial, not from a cash flow statement. Sorry, not from a cash flow kind of statement. So let's take a look at now the fundamentals, starting with net income 5 years ago of $15.5 million to 1 year ago of $160 million, negative $160 million. And that is why we can't see the PE. Didn't realize that, I'm pretty certain that they had positive net income. I forgot that no, as of 1 year ago, they had negative net income, which is why we're seeing that PE and A, right? So we can see that from 5 to essentially 2 years ago, consistently increasing, a little bit of a big jump from 4 to 3, and then from 3 to 2, and then the boom, massive collapse, probably because of the interest rate hike, right? Probably because of the interest rate hikes. There is a decrease of 1,131% on the 5-year. Guys, I gave this thing a 30%. Honestly, I'm looking at it now. I might go it lower, but let's just say with 30% for now, it's really, really bad. Looking at the free cash flow, so about that, the free cash flow. Here's the thing, right? Here's the thing. From 5 years ago, negative 10.8 million to 1 year ago of negative 7.8 million. That is an increase of 28% with an average of negative $6.2 million. Okay. All right. If you take a look at this from 5, 4, and 3 to 2 years ago, pretty consistently increasing, even though it's in the negatives, guys. It's still, if you would just erase this over here, like that 1 year ago value, it looks good. It does. A little bit of an outlier here and there, right, from the massive jumps, but all in all, it's still looking really good. And then as of 1 year ago, boom, instant collapse. Again, probably because of the interest rate hikes. But interest rate hikes are probably going to get a lot worse, right? Probably going to get a lot worse. And because of this whole nonsense of it going up and then coming back down, I'm actually going to give this a 50% because I have no idea where this is going. I really have no clue. So 50% for the free cash flow. Looking now into the revenue. Honestly, not too bad. By far the best one out of all these profit metrics. 5 years ago of $366.6 million to 1 year ago of $873 million, increase of 138%. You can see that consistently increasing from 5, 4, 3, and then the massive jump from 3 to 2, and then comes back down to earth. Honestly, it really does, going from 726.5 to 873 from 3 to 1 year ago. That's not too bad, right? That's not too bad at all. And I'm going to take the 2 year ago value as an outlier. Therefore, I'm going to give this a 95%, the best one so far. But the revenue, guys, is only one metric, right? It's only one metric. Free cash flow is everything. Now, looking at the total assets minus total liabilities, it kind of follows that of the free cash flow. And we can see that it's pretty consistently positive, which is good. The outlier happened 2 years ago. Okay, that's understandable. And then it comes back down to earth 1 year ago. And so far this year, they're up to $615 million. I have a feeling that they can beat 1 year ago value. So that's perfectly fine. Average total assets, it is 4.7 billion. Average liabilities is 4.1 billion. Doing this difference, we get $655.84 million, guys. I gave this an 85%, mainly because it's looking very, very similar to that of the revenue. However, because this 1 year or this today's value isn't up to par with 1 year ago value, I'm gonna give it a little bit of a dent. 85% though, still really good. Now, when it comes into the cash flow minus the liabilities, there really isn't much to say anything here. I mean, consistently decreasing. Lowest point was 1 year ago. That's bad. But, you know, negative $5.4 billion. That's 1 year ago. Consistently decreasing every single time. Average, it is negative 3.2. I gave this a 0%. Very, very bad overall. And lastly, when it comes into the shares outstanding, very consistently increasing. However, as of 3 years ago, we can see that it did fall a little bit, going from 5 years ago of 26.2 million to today of 28.1 million, increase of 7.25%. Previous year to the current year, that is a buyback of 1.4. Overall, though, consistently increasing. I'm going to give this, guys, a 20%. It's higher than 5%. That's why I'm giving it, you know, a 20%. And lastly, cash and equivalents, they currently hold $210 million with an average of $191 million. Looking at the overall grades, we gave them an income of 30%, free cash flow 50, revenue 95, assets minus liabilities 85, cash flow minus liabilities 0, shares outstanding of 20%, overall grade of 49. Main problems here is that cash flow, man. That cash flow, it is bad, bad, bad. It's in the negatives, right? It's in the negatives. They were doing really good there for a little bit, and then just boom, instant collapse. So, you know, it is what it is. I think interest rates will continue to go up, right? They also have problems. Well, their net income was mainly an issue as of just 1 year ago. Interest rate hikes probably, and I don't think that that's going to go away. So 49%, it's looking really, really bad for me, guys. It really, really is. So if we take a look now at the discounted free cash flow, for starters, I already have some of these numbers in, right? And, well, after debt, guys, they're all in the negatives because this company has a lot more debt than they do cash on hand. So we're only going to focus on the target share prices, not adjusting for debt. And let's just say the predicted share buyback, because that's the most, I guess, the one that we can see the best. And that is around 7% issuing of shares in the past 5 years. Pretty consistently too. So I said -10, -7, and -4 for the next upcoming 5 years. Now for the revenue, this one was difficult because, well, Seeking Alpha doesn't have a revenue growth forward. It is what it is. So therefore, I decided to just go with 1, 2, and 3%. That's it. That really is it. Is that wrong? I don't know. Is that right? I don't know. So with that, we get the target share prices of $9.83 to $11.19. So currently, it's looking expensive still. It's looking real expensive still. It's a company that, I mean, to be fair, I wouldn't even look at the price at this point. I would have just seen that. Honestly, just that free cash flow alone, I would have been like, nope. If it would have gone to positive or at least closer to 0 1 year ago, instead of going further deep into the red, like rebounding back into the red, yeah, I would have looked at it a lot better, but that right there killed it for me. So this is just my assumptions when it comes to this, guys. Obviously, do not take my word as, you know, I guess a law, because they're not, right? I'm not telling you guys what to do. KLL, you recommended this. I'm so glad that I got picked before like one of the last ones, like last time. So I highly recommend, please do your own due diligence when it comes to this company or any company. And yeah, I mean, it's a company that I don't necessarily like. I'm sorry. I just don't. I think it has a lot of problems to begin with, and it is what it is, man. It is what it is. But again, please do your own due diligence. All of these calculators are available for free because I want everybody to do their own due diligence. And yeah, I'm not telling you guys what to do with your money. The best way that you guys can help us, if you would like to help us in our endeavors, both Mike and I, is just to like, subscribe, comment. It really does help her with the algorithm on YouTube, guys, as well as Rumble. So again, we are live streaming if you guys would like to stop by The link is in the description below. You don't have to have, well, you gotta have an account to whatchamacallit, to like and comment all that stuff. But if you guys just want to watch, you guys could just, link is in the description below to the Rumble stream. It'll be, actually I'm gonna stream tomorrow at 8:20 a.m. because jobs come out non-farm payrolls come out tomorrow, and I kind of would like to cover that, so that's gonna be interesting. If you guys would like to help us, that's the best way that you can help us. Like, subscribe, comment, guys. It really does help here on YouTube as well as Rumble. Looking at this overall price, guys, when it comes to this dividend, I mean, 8% yield is huge. We got $5,725. If we were to invest this, we would get $516.60 in annual dividends. Absolute insanity. Problem is, with that payout ratio and that free cash flow in the negatives, they can't afford it, guys. They really, really can't afford it. So it's looking good. Do not buy a company solely for its dividend because it could be a trap. So be very, very careful with that. And they do have history of cutting it as well. And if we take a look at the option chains, we can see here for July 21st, it really isn't much of any. Well, actually, there's $30 for a strike of $42.50 on the put side. And on the call side, honestly, if you guys would like it, this is one that you might want to sell a covered call if you do have 100 shares and you don't want them anymore. So that might be one. If we take a look at the August 18th, here are, wow, those are some good ones. Whoa, look at that. For a strike of $37.50, you're getting $105. Wow, guys, that's actually somewhat good. Honestly, not gonna lie, it's really, really good. And then this is for August 18th, though, so it has a month left, more than a month left, actually. So just keep that in mind. And then on the call side, wow, $235 premium for a strike of 45. Maybe, I don't necessarily know. Whenever you bought this, I don't necessarily know, but consider it, I guess. All in all, thank you so much for the recommendation, KLL. I'm so glad that it got chosen. You know, again, it was chosen on the live stream, but I figured, you know what, for you, actually, and honestly, for anybody, I would have liked to do a more thorough analysis on it. So, nonetheless, though, guys, that pretty much does it. Again, another company I like. I think there are better financial companies out there. So that pretty much does it. Y'all can follow us on the new tech sites. Link is in the description below. So, as I said, peace out, and we'll see you all next time.